Hey everybody, good to be here today. My name is Brent Moores and time for Advanced Option Strategies. I actually want to start kind of a series this week that's going to extend out into several weeks, but I want to start off with kind of a foundational strategy, one that's a great strategy, I think, in its own right to learn and to consider, but one that also provides a building block for other strategies. So namely, that is going to be iron condors we're going to talk about today. And there's a lot of ancillary topics that go along with iron condors, things such as, vertical spreads, probabilities, risk reward, stuff like that. It's all important stuff. We're going to hit that up next. Glad to see some familiar names in the chat. Glad to see you here. I'm also glad to be joined by Mr. James Boyd, who's helping me out in the chat. Appreciate James. He has some great classes throughout the week, including he has a class called an Investing Master Series. I want you to check that out. That's on Tuesdays at 11 o'clock Eastern Time. You can follow James or myself on X. We both post throughout the week for additional content at Brent Moore CS, at James Boyd CS. And let's hit up the disclosures real quick, then we'll get a little bit more into the subject at hand. But remember that options do carry a high level of risk and are not suitable for all investors. The information today is for general informational purposes only. It's not an individual recommendation or endorsement of any particular security strategy or chart type. Schwab does not recommend the use of technical analysis as a sole means of investment research. The paper money software application, which we will be using today, is a great educational tool, but it is provided for educational purposes. I do encourage you to try out some of these trades on paper money to learn them in a no-risk environment there. All investing involves risk, including loss of principal. And rolling strategies can entail additional transaction costs. There's no guarantee in execution of a stop order at or near the stop price. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. And there we go. And just a reminder, I'll be looking at individual stocks and options here today, and they're examples, right? Okay, so market's not having a good day, is it? I mean, the S&P 500 is down almost 2%. We drew these lines in here back when we were in this time frame. Let me zoom in here just a little bit so you can see. We had this big drop. This was down about a 10% drop in the S&P 500, and I saw someone, who was it, TM was saying, we're going to 20%. Well, we may. It's maybe a little bit early to call that, but I don't know. In past classes, we've looked at the history of this, and sometimes we get 10% drops, and sometimes it's more. We've seen 20% drops, and 20% isn't unheard of or out of the realm of possibility. But what we saw is a little bounce, and then it kind of went this sideways pattern. And we were going, well, is it going to break out of this kind of channel? And it broke out, and then we dropped back in it. And then the question is, are we going to break below it? And so the jury's out. We got a couple hours left in the trading day, in the trading week. This morning we had kind of some economic data that wasn't great. Lower consumer spending and higher inflation. That's not a great combination. That's kind of a stagflationary combination there. Who knows? You never know exactly what's driving the market. Even if the numbers came in better, maybe we would have had a sell-off. I don't know. But I would submit to you that this is probably a fairly key level where we bounced off, where we're kind of at right now. And if we break below that, that would be not a great sign. We'll see next week. Now, you may be saying, Brent, the market's down. There's a lot of stocks. Not all stocks are down, number one. And even if they go down, we're in a more volatile situation right now, a more volatile market. You can see that in implied volatilities. And so I'm not expecting this. The strategy we're going to be talking about is a little bit more of a neutral strategy, but neutral strategy does not mean that the stock doesn't mean the stock just goes sideways, right? It may go up and down, but the theory is if it goes up a bunch, it's likely to retrace back. Or if it goes down a bunch, it's likely to retrace back. In other words, you end up perhaps in an area, a realm, sort of where you started, okay? And the point between here and there may be kind of a rocky road, but that's the whole point of some of these strategies. So what I want to do is I want to look at the basics of an iron condor today. Okay, I want to look at the basics of an iron condor, and then I want to discuss placing iron condors using example trades. But the first thing I want to do is for those of you is I want to kind of write out, just get out some information initially on this, on iron condors, what they are. And this is a little bit more of an intermediate or advanced class, so I'm going to assume you have some options for knowledge here, right? When I'm doing these, when I'm talking about these. So if you're brand new to options, we do have a getting started with options class as well. But an iron condor is made up of, it's a short put vertical plus a short call vertical. Okay? And so, just to kind of graphically draw that out, basically what you have is if you have a stock here, I don't know if you can see that in the yellow, let me change that color a little bit here. If you have your stock here, you can do a short call vertical, which is bearish. We want the stock to stay below kind of the short strike on that short call vertical. We have a short put vertical down here. We want the stock to kind of stay above there. And so net, we end up with more of a neutral trade. We want the stock to stay kind of within these sidelines, if you will, So, and very often the way we do these, and so, you may be familiar with short call verticals, short put verticals. Very often in classes that we teach, I'm going to say we're going to do these 20 to 40 days till expiration, 20 to 40 days. Now, we don't need to, this isn't a strict parameter, the 20 to 40 days, nor are any of these parameters I'm going to tell you. I'm going to give you some other things that we may look at in this class. These are ideas that we're going to kind of follow in this class, but it doesn't mean these are absolute rules that you have to use. But we're going to stick in that kind of typically 20 to 40 days till expiration. That tends to help us out in a couple ways I'll mention here in just a minute. It's a non-directional trade, okay? Generally non-directional. I just kind of illustrated that for you, but you can skew it a little bit depending on what strike prices you need. Okay. In other words, if our stock is here and we do a short call vertical here and we do a short put vertical down here, we have just skewed that to be more bearish. Okay. But in general, we're going to call that a non-directional trade on there. All right. Number 3, and this is going to that 20 to 40 days to expiration. It's a positive theta trade. Time decay helps us out on that trade, assuming the stock kind of stays where we want it, in between those verticals. It's positive theta. Technically, that can change. And it's a negative vega trade. Okay. Theta tends to be highest as we get closer to expiration, which is why I don't say 20 to 200 days to expiration. Can you do an iron condor that long? You can, but generally these time periods are going to give you more time in that zone of the higher time decay. All right? Okay, so let's move on. Number 4. Okay, I'm going through these fairly quick if you can't tell, because I kind of want to get the information out and I want to get to real life examples here. But I also want, this is a series that I'm trying to lay the foundation of different strategies. And so I just want to get out the basic information here. So what's the max gain? The max gain is the premium you receive. Premium you receive. Now you're receiving premium from that short call vertical, and you're receiving premium from the short put vertical. Those two together. So kind of double whammy premium, double the fun there. Premium, that's great. And the stock you can only lose on the call side or the put side at any one given period of time. Okay, so that's a good thing about it. Now, it's not all good because it can go against you on the high side or the low side too. Okay, it can go against you either side. But the max loss is, this is maybe a little more, well, it's the difference between the strikes minus the premium. Okay, and that, I'm kind of assuming, and what we're going to do today, and in the past we've tweaked it a little bit, but today I'm just going to assume our strikes are equidistant. Okay, in other words, let's say I have a 56, 58 short call vertical, I may have a 48, 50 short put vertical, $2 difference between those. So on those, let's say I've got a 50-cent premium or something like that. What's my max gain? My max gain would be the 50 cents. What's my max loss? The difference between the strikes, $2. Okay, $2 minus the 50 cents. The max loss in that scenario would be $1.50. See how that works? So there we go. So that's our max loss. Now, what about break-even points? Break-evens. Okay, so break-evens are going to be the put short strike minus the premium, or the call short strike plus the premium. So in other words, when you go into this, I want you to have in mind, we don't want the stock to go above our short strike on the call side or below our short strike on the put side. But the reality is the break even is actually a little bit above that short call strike and a little bit below the put strike there. So, and the probability and risk reward depend on strikes chosen. Okay. Now, on any trade, I don't care whether this is a iron condor or a long call or a short put or a butterfly spread. The things you need to think about, you need to consider on any trade are, number one, what are your probabilities? Okay, what are the probabilities of the trade? Number two, what's your reward to risk? Okay, you also probably want to consider what's my forecast on the underlying and where does that match up with where the stock, the technical analysis where does the technical analysis match up with that strategy in terms of where we need the stock to be for our max gain on that. Now, there may be other things like theta and vega or Greeks, yes, but really probability, reward to risk, and then what's your technical analysis if it's how is it matching up with where we want the stock to be. I've got 11 of these, I'm almost there. Let's see. So for our purposes in this class, I'm going to look for a probability in the money around 20% on each side. 20% on each side. Okay. So if you think about that, if we have the call side, the short call vertical side, and we say, oh, there's about a 20% chance that's in the money on that side. And if we have a short put vertical and we say there's about a 20% chance it's in the money on that side, okay, where does it leave it? It's in the middle, about a 60% in the middle. Now, obviously, we're not going to hit 20% exactly, but that's going to give us what we're going to call a higher probability trade. Higher probability, I just mean above 50%. Okay, so I'm not like, when I say high probability, I'm not saying, hey, there's, a 90% chance or anything like that. But that's going to give us, this is not, iron condors aren't necessarily high probability trades. It depends on the strike you choose. The further wide, the further out there you make your strikes, the higher probability, but you're also damaging your reward to risk ratio in that circumstance. You can make it a higher reward to risk ratio by scrunching in those sides, and there you go. So that, but your probabilities are going to go down there. Okay, what about exits? Okay, well, if we're in the money, let's see. Let me do this first. If stays out of the money on both sides, okay, then we're going to exit at, you could exit at like a 50% gain, 50% of your max gain, or you could, you're going to have we'll say exit less than 10 days to expiration. Okay, so that's going to be if it stays in the middle, there's a very good chance it's going to go to one side or the other. Here's another exit rule. If in the money, we're going to close or roll winning side. Okay, so what do I mean by roll here on this? Let's say we have this, and we have our short call vertical and our short put vertical, and we'll just say for our purposes the stock goes down. Okay, that short put vertical may not look very good at that point. We'll probably be losing it. But what we can do on that short call vertical is we can either just close it out and take some profit on that side, and then we can worry about that short put vertical side, or we can also roll that short call vertical to a lower strike, because remember, the stock has now moved down here, and bring in a new credit down there. Okay, so that's a possibility as well. So, so that's how we can manage that, or we can exit on technical breakdown. If it completely is going against us and we don't think it's going to recover from a technical standpoint, that it's not going to bounce back, then we may just exit. The good news is, as long as you're before expiration by several days, hence the exit less than 10 days to expiration, then you're probably not going to be anywhere near that max loss. I can't make any guarantees on any one trade, but generally there's enough time decay in there, unless it just moved completely against us a long ways, that usually you're not going to be near that max loss there. Okay, and the last item I have before we start looking at some of these examples is money management, and that is, again, this is just kind of the rules. We're going to say 1 to 2% of portfolio risk. So that's going to be how much, and how much is that? What's that going to be? That's going to be, we're going to go to the max loss to figure that out. And that'll help you to determine the number of contracts as well. All right, let's head on over to the Thinkorswim platform. Okay, enough of that. Let's look at an example. There's a lot of examples we can do. One challenge that we're going to have right now is we're banging up right against earnings season. Okay, here's Wells Fargo. This is going to, those big banks tend to be the first day of earnings season is what we consider earnings season. You can see that popping up on the calendar there. Another way to see your earnings date, if you're not seeing it on popping up on the chart, if you're not seeing it on the chart, you can go to the Analyze tab, go to Earnings, and it'll just tell you right there. We got earnings on April 11th. Let's see, Iron Condor only with short put vertical. There's Iron Condors have short put verticals and short call verticals. So I'm not sure I'm following your question there. I may have wrote something on my screen there. I apologize on that if I miswrote that there. But yeah, short call verticals, short put verticals. So that's, you can see earnings. And now, does that prohibit you from doing an Iron Condor here? Okay. Ricebird actually brings up a good point. We don't have to do that all at the same time, right? You can leg into the Iron Condor I could start out and say, well, look, I'm going to do a short call vertical up here. I'm going to wait, and then maybe this bounces and do a short put vertical, okay? So we call that legging into that iron condor, and that's absolutely acceptable. You can certainly do that, okay? Now, on this though, we have earnings. So what are we going to expect with earnings? I don't know if this stock's going to go up or down with earnings, but probably there's a good chance it's going to move quite a bit with earnings. And so why could you still do an iron condor? Well, one reason you can is this. One reason you can is if you look at, say, implied volatilities are high. They may raise up a little bit more, and then after earnings, they tend to drop. Here's earnings, implied volatilities dropped, earnings dropped a little, not huge. You can see other stocks drop more. But in other words, prices of options are going up, and therefore premiums are going to be higher. So since premiums are higher, it gives you a little bit more wiggle room in terms of what strikes you can do there. All right. Now, I'm not actually going to do this because I would say most traders that I encounter, and not everyone, are going to say, look, if you have earnings coming up in the next couple of weeks, let's just avoid that earnings for the iron condors there. But realize it kind of, you don't have to run away from earnings on every trade you do. Implied volatilities kind of help compensate you on that. But you can see that and you can look and make up your own mind on there. The problem is, it's not just the start of earnings season. A lot of other companies are going to have earnings too. Let's look at Intel for a second. Intel's been in the news. It's had, if I go to a longer term chart, it's had really a miserable time for a long time. I mean, this is a 3-year chart. It was at 52 3 years ago. We're now down at 22. That's not great, I'll tell you that. But more lately, let me just do this plain. You can see we've kind of been in this channel. And so from a technical analysis standpoint, it probably makes sense to say, oh, look, you've got this channel, around 26 resistance, around 19 support. That's more sideways. That's kind of going with our more directional. And this has indeed dropped with the the market's dropped some. This has dropped a little bit. We're down, well, 4% today, which is a fair amount, but we can go down a little bit further there. So there we go. What other technical analysis you could do? Well, you could look at your moving averages. What's our moving average? Well, our 50-day is sloping up. Our 20-day is going sideways. There's not a lot of conviction in terms of the moving averages, I would say. Okay. Support resistance. You could do volume profile. Okay. There's our volume profile. Let me go out a little bit further on this volume profile here. Let's go to year. So here's a year. Where has the trading been over the past year? Well, the trading's been in here. This is our non-directional. All those. I don't care what you use. You don't need to use that volume profile, moving averages, but your forecast is more neutral. So let's look at a more neutral type trade. So I'm going to go to trade. I'm going to go to my options. Now, we have earnings. We're going to have earnings. I forgot where it is. I think it's in about a month. You can usually tell by looking at the highest implied volatility, which is going to be right here. That tells me there's probably earnings right before that, I'm guessing. But let's do what we did before. Let's go to analyze earnings on May 1st. Okay, earnings on May 1st. So we're going to go before that May 2nd. We'll go to April 25th. Okay, April 25th, and we're going to look. And now remember, I said we talked about expiration dates. I said kind of 20 to 40 days ish. Yeah, there we go. I said about 20% probability of the money each side. You can pull up your probability of the money. You can use delta, which tells you how much the option is going to move in relationship to a $1 stock price move. As a substitute for for that. This gives you approximately the same thing. So what I'm going to do, I'm going to go to about a 20 delta there. And I've got a 21 delta, 19 delta, I go to 21 delta. Remember, the higher price I choose, the more premium I'll get. Yeah, it's sweet, more premium, but lower probabilities. So I'm sticking with about that 20. I'm going to go here and I'm going to sell this one. So I'm going to click on that bid price. Okay. And I'm going to go out and I'll spread these out $1. Those are 50-cent increments on those options. Okay. Well, it's Intel, it's a low price stock. You get that happens. And I'm going to click on my control key, hit my ask price. That's my call spread right there. 26.27 call spread on this. And you can see the open interest here on these. You can look at your bid ask spreads on these to try and double check. Liquidity is an issue. Generally, just a little side note, I don't care what watch lists you use. You can create your own. But for more liquid stocks, typically I'm looking at things like S&P 100 stocks. If you expand it out to the whole S&P 500 without whittling it down any further, you're going to end up with a lot of lower liquidity stocks and lower liquidity options, which is not a good thing. Okay, so just be aware of that. Okay, let's go to the put side. Now, remember, probabilities aren't guarantees. It's just a mathematical probability. Okay. So again, I can go to this side here and we can look. I'll go to Delta 2017, 22. I'll go 2050, hold down my control key, click on that. I'm going to go to 1950, hold down my control key, click on that. That is an iron condor. Now, what's our reward to risk ratio? Well, our reward to risk ratio is not going to be positive, right? This is a higher probability trade. It's more of a neutral trade, higher probability. We're going to take advantage if implied volatilities drop. I don't know where implied volatilities are going to go, but especially on a day like today, where I don't know what the VIX is right now. I imagine the VIX has jumped a fair amount today. The VIX is up 16% today. Well, yeah. When the market tanks, the VIX goes up. Back to Intel. Let me go here and let's just kind of look at this. I'm going to analyze the trade. Let's go to risk profile. This is what it looks like. Let me just kind of do this here. Okay. This is what it looks like. Okay. Iron condors look like this. Okay. Okay. There's more distance between where we're currently zero, break even, and the max loss. In other words, our max loss is greater than our max gain here, potential gain. Okay. Where do I want the stock to be? Well, I want the stock to be between my strikes. Let's see. Today's the 28th. On this trade, we're looking at April 25th. Let me go to April. We'll do that. Set slices. Break even. Set slices to a chart. Here's our chart. Okay. Here's our chart. These lines, okay, I'll kind of draw over them so we can see them because there's actually the ones that extend all the way to the left. Okay, this line. This line represents our high side break even. This line represents our low side break even. Now, technically, I drew a support level down here. Is that going to rule it out? No, I mean, we probably have support. There's a good chance we're going to hit support elsewhere. And even if it were to dip down, doesn't mean we're exiting immediately. We could wait for it to see if it bounces there, okay, and get back in there. Now, when we say break evens, those are break evens at expiration. All right, so there we go. Let's do this. Now, what about exits? Well, on this one, what I'm going to do is I'm going to manage how we said before, and I'm not going to put in stop losses. You can put in stop losses on these. Furthermore, this is an iron condor. We have a short call vertical side, right? We have a short put vertical side. And what we're going to do is we're probably going to kind of manage them after we enter it. We're going to manage them separately. Okay, the short call vertical side, the short put vertical side. Just kind of break them up. All right. Let's see. So let's place that sample trade. Remember, one last thing before I do this. If I want to make this a higher probability trade, I could move these strikes out farther wide from one another, but that's going to hurt our credit. Okay. Mid price, we'll go in just a little bit, see if we can get filled here on this. I'm going to go to short verticals, iron condors. We're going to submit that, and we got that filled there, okay? So now it's going to be sitting there in our short verticals, iron condor area, grouping there, okay? So we'll see on that. When you look at these, you can just click on it and you can see this. Here's this side, here's this side. Okay, I just did one contract. I probably should have done more in hindsight. I didn't really think of that, but right now we could have done more contracts on that and still gone within our money management parameters there on that. But we'll get a good sense of managing this. These are slower moving trades. If you're going to look at this and expect to be anywhere near a max gain in the next 10 days, you're probably, don't hold your breath would be my take on that. Because if you think about it, like on a lot of if you're doing just a long call, can we get a very big gain quickly? Yeah, if the stock goes up a lot really quickly. This is an iron condor. If the stock goes up a lot or down a lot, it's not making any money. That's not good. The best it can do is kind of just languish sideways for a little while. Have implied volatilities drop. But this is, by its nature, it just isn't, delta is not going to help you out much here. Okay. If you think of the things that move an option trade, the biggies, the stock price move, time decay, and volatility, the one that moves quick, typically, much quicker than the others typically, is the stock price move. So that isn't working in our favor. But let's do this. Let me go back to our Analyze tab, and then we'll look at a different trade. What I want you to notice is this. This purple line represents where we're at right now on the trade. Where we're at right now. The blue line, this one, I'll make it red for our purposes here. Okay. This represents at expiration. Okay. The difference between those is basically time. Okay? It's basically time. So when we say it's positive theta, over time, this yellow line is, if it goes up, it's going to go closer. It gets better and better. That's positive theta. That's positive theta there. Now, if the stock goes against us a lot, time decay actually works against us. It gets worse and worse. Okay? That's negative theta. But here's the thing. Let's say the stock goes completely against us. Let's say the stock goes down to $19. That is a max loss position at expiration. Okay? $19. But what if, let's say, let me go here. And let's go forward a couple weeks. Let's go to the 10th. We'll go to April 10th here. So that's about 2 weeks time frame. Okay. Our max loss at expiration, which is right here, we're losing $74. We're only halfway to our max loss, in other words. And again, this is just an estimation, but that's the point of this. Even though the max loss may be kind of intimidating to you, typically with more normal type moves, it's not going to be that bad typically. You may lose money if it goes against you, but you're probably not going to be now max loss. Now, if it goes down to $15 or up to $30 or something, that may be a little bit of a different story there on that one, right? Okay, let's look at a different example here. Okay, let's look at NEE. Okay, here's NEE. This is not a stock that we trade a lot in the classes I teach. It's sideways. It's more neutral. Now, if you want to do an iron condor on a stock that was rocketing up and you felt, well, it's exhausted itself, it's now going to consolidate, you can do that too. Okay, so there we go. It doesn't need to be a perfectly neutral stock. It doesn't. I mean, to some extent, it doesn't matter what the past has done. Okay, for our technical analysis purposes, if we think it's going to stay in this zone, yeah, we're using that to try and anticipate the future. But in theory, the past doesn't. We don't know what the future is going to do. It can be sideways in the past and be crazy volatile, go way up or way down in the future. Likewise, it can be very volatile in the past and be sideways in the future. Ultimately, what matters is the future. But for our purposes, for the purposes of technical analysis, when we look at things like the trend, what are our moving averages doing? Well, they're going sideways. They're not indicating a lot. It may change, but they're not indicating a lot right now. Let's do that volume profile. What's that? Well, it indicates most of the trading has been kind of in this area here. Does that guarantee the future? No, it doesn't. Okay. But support resistance lines, we could draw those in there. Same thing. So let's go to the trade tab. Now, earnings. Remember, we're in earnings season here. So let's go to analyze. Let's go to earnings and see what we got. April 22nd. Okay. Again, I could trade after earnings. Let's see if there's a bump. Not a huge bump in but you can see this is where the higher implied volatilities are. That's typically going to be the first one after earnings. Well, let's go right before earnings. How many days does that leave us? Wait a second, April 22nd? Did I get that right? Let me just double check. Analyze. April, so look, there's an exception, April 22nd. This one actually, interestingly, higher implied volatility, not on the one that is immediately after earnings. Well, that's why you double check. We're going to go to the monthly contracts here on this, okay? And that's probably good as well. Just in my experience, NEE doesn't have quite as liquid options as a lot, so sometimes going to the monthly contracts will help. Again, I'm going to go to Delta, or you know what? Let's switch it up. Let's go to probability in the money instead of Delta, okay? Here we go, 22%. I'm going to go to the 74 call. I'm going to click on the bid price. I'm going to go out, we'll go out a couple, 70, I'm going to go 75. We'll go out one strike, okay? We'll do that, okay? We're going to the put side. Probabilities aren't guarantees. Nothing that close to, we'll go to the 67. I'm going to sell that. Hold down my control key and the 66, okay? And we got to be a little careful on this. We had some wider spreads on that. Not loving that. It's going to change, but notice the mid price to the natural price. That's pretty big, okay? I'm not willing to do this. Well, let's look at it this way. Right, what's our max gain? What's our max loss on this? Well, our max gain is the initial credit, right? $55. What's our max loss? Difference between the strikes which is $1 minus that. Well, that looks pretty good, okay? That looks pretty good. That is artificially high. Realistically, we're not going to get filled in this. I mean, I don't think in paper money we're going to get filled in this. In real life, I'm pretty confident we would not get filled at a 57-cent credit here on this, okay? not with the higher probabilities. But look down here. Your natural price is 28. What I want to get as much credit as I can on this. Ideally, I'd get filled at this higher price, but realistically, it's going to be less than that. But I'd like to, so let's split the difference here and see if we can get filled on that, okay? So here's what I'm going to do. I'm going to go down here, get rid of my drawing tool. I'm going to go down here. We'll go down the middle, okay? I don't know exactly what the middle is, but we're going to put that in. And I'm going to confirm it's in. I'm just going to look. Max loss 57. We can do more, okay? Let me edit that. Let me up my contracts. We'll do 4 contracts. I'm going to confirm and send. Put this in my iron condors. Send that. See if we can. It's not filling. We may need to go and let it run a little bit more. The bid-ask spreads aren't good on those. So if it fills, it fills. If it doesn't, it doesn't. Okay. You got to be willing to walk away from trades if they're not going to give you the numbers that you want on that. Okay. That's how that goes. If I can't get filled for that, forget about it. Okay. Now, you can automate the exit on these if you want. Okay. Well, I teach these probably more weeks than not. If you join this class, I talk to you about automating exits using conditional orders to get out. So that's what we're going to do. But I only have a few minutes. Let me kind of finish up. I want to look at Disney here. Okay. Because this is not an iron condor, but it's a short call vertical. And remember on these, I said, we're going to kind of manage them separately. So this really is speaking to the iron condors here. This is a short call vertical spread. Remember, on any trade you're looking at, you want to have an exit in mind if things are going well, if things are going bad, or if things are just kind of going okay. Right now, I'd say they're probably going kind of okay. We're up 19, 20 bucks, whatever on this, a little bit, but not a ton. So they're going okay. The typical exit on these, whether these are iron condors, we're looking at individually, or on individual short verticals, is if I'm less than 10 days, if I'm a week out till expiration, if I'm a few days out to expiration, somewhere in that time period, about a weekish or whatever, we're going to look to get out. Well, we're doing okay. Are we within a week to expiration? No, we're 20 days to expiration. We're going to let time decay work. Here's our theta on this. We're making about $3 a day, which isn't a ton, but it's not a huge trade. $3 a day on theta. Now, that's not a realized gain of $3. Okay? That's not a realized gain, but that's everything else being equal. $3. Okay? There's a request in the chat, and I'm going to continue to talk as I show this. But the request in the chat is some people want me to be able to take a, look at this a little bit more closely if they want. There you go. Just realize these are not ironclad rules, not ironclad rules for an iron condor. These are the rules for this class, this particular webcast for an iron condor that we're going to be looking at generally, that we generally abide by. And a lot of these rules are going to bleed over to other type trades. So when I talk about other types of trades, you're going to hear me talk about, we're going to exit if we get under 10 days to go to expiration. We're going to exit if we get that 50% gain. You're going to hear me talk about that more. We're going to exit on a technical breakdown. Those aren't unique to iron condors here. Okay? But on this one, so our short call vertical, we're not exiting just because of time on this. Have we made most of what we can make on it? No, we haven't made most of what we can make. The initial trade price is, well, look, let me get rid of that. The initial trade price was about $1.46 on that, $1.46. So if this gets to zero, where it's worthless, that's the most we can make. How much have we made? We've made about 22 bucks of that. We're definitely not at over 50%. We're not at 75% on that 80%, where a lot of times we'll close out of. So we're going to sit with it. And we're not losing money on this either. In fact, we have a stop loss on this as well. I don't have a lot of time here, but let me just mention this. I have an exit if we get out, if it goes up to $3.20 or something. Well, we're still a ways from that here. That's $3.20 right now. That's the combined price of the two. All right. Okay. So I got to finish here, but let me just kind of sum up. This is the first of a series I'm going to do on different trades. I kind of wanted to start from the basics. We'll get more complex as we go, but I wanted to start you with iron condors here today. Okay, I'm hoping you find this helpful as an introduction to iron condors. Coming up next, we have ThinkScript studies. Make sure you check that out. Mike Fairborn teaches that. He does a wonderful job on that. I want to thank James for helping me on the chat, of course. And we talked about some guidelines for you. Practice on paper money. That's the key. Practice, practice, practice. And remember, these iron condors, we may enter them as iron condor, but oftentimes we're going to manage them as just a strict vertical, two different vertical spreads. Okay, everybody. Have a great rest of the day and a great weekend ahead. Bye-bye, everybody.